Welcome and thank you for joining today. We are going to dive into the fixed volume profile trading strategy. By the end of this, you will know how to set up the fixed volume profile, understand what it is telling you, and use it in your trades with more confidence. It is an exciting tool that can really sharpen your skills by highlighting key price levels and helping you make better decisions. Are you ready to unlock the hidden story behind market movements? The fixed volume profile reveals crucial insights that most traders overlook. Imagine knowing exactly where the most significant buying and selling took place, and understanding why those price levels could make or break the next big move in the market. This is the kind of edge that the fixed volume profile can give you. It highlights those critical points where trading activity was at its highest, often marking areas of strong support or resistance that traders need to watch closely. To fully capitalize on this, it is essential to understand the common chart patterns that appear around these key levels. Patterns such as double tops, double bottoms, head and shoulders, inverse head and shoulders, flags, pennants, wedges, and triangles frequently form around significant volume nodes, providing powerful clues about where the price might go next. For example, a head and shoulders pattern forming near a high volume node may indicate a potential reversal. The head and shoulders pattern is characterized by three peaks, with the middle peak being the highest, resembling a head, while the other two are lower, resembling shoulders. When this forms around a high volume node, it often means the market has exhausted its upward momentum and is ready to reverse. Similarly, an inverse head and shoulders pattern, which is the opposite of the head and shoulders, may indicate a potential bullish reversal when it forms near a high volume node. Double tops and double bottoms are also crucial patterns to recognize. A double top is formed when the price reaches a high point, retraces, and then tries to retest the same high but fails. This indicates strong resistance at that level, particularly if it aligns with a high volume node. Conversely, a double bottom forms when the price hits a low, bounces back, and then returns to test the same low without breaking it. This pattern signals a potential reversal to the upside, especially when found near significant support indicated by a volume profile. Flags and pennants are continuation patterns that signal the market is taking a brief pause before continuing in the original direction. These patterns are characterized by a sharp price movement followed by a consolidation phase that forms a flag-like or pennant shape. If these form around a low volume area, they could indicate that the market is gearing up for a strong continuation move. Wedges and triangles are also common chart patterns. A rising wedge is typically a bearish pattern that shows slowing momentum in an upward trend and often results in a reversal downward. A falling wedge, on the other hand, is a bullish pattern that indicates a potential reversal to the upside. Triangles, whether ascending, descending, or symmetrical, show periods of consolidation before a breakout. If these patterns form near key volume areas, they can provide powerful signals about the upcoming price direction. Recognizing these patterns in combination with the volume profile helps refine your trading strategy and gives you more confidence in your decisions. By understanding where significant trading activity occurred and how these patterns behave around those levels, you can better anticipate potential market moves and make informed trading decisions. Stick with me here because you are going to learn how to set this up step by step. We will make it easy, so do not worry if this is new for you. First, you need to navigate to the indicator menu on your trading platform. You will search for the fixed volume profile and select it. The next part is choosing a specific range on your chart. You might pick a recent trend, a breakout, or maybe a time when the market was going sideways. Once you have chosen that range, draw the profile over it, and there you go, you are ready to begin. You will want to adjust some settings to make this profile work best for you. Fewer bars will give you a simple overview, and more bars will show you lots of detail. Think about whether you want to see the big picture or the finer details. There is no wrong way, it just depends on your trading style and what kind of information you want to see. Now let us go over the key parts of the fixed volume profile. There is something called the point of control. It sounds fancy, but all it means is that it is the price where the most trading happened in your chosen range. Imagine this as a key battleground where both buyers and sellers thought the price was fair. Because so many people traded there, this price tends to become a strong support or resistance level in the future. Then we have something called the value area. This is the range where about 70% of the trading volume occurred. Think of it like the sweet spot of trading activity, where most people agreed on what the fair price should be. Inside the value area, you will see high volume nodes, which are spots with a lot of trading activity. These high volume nodes are crucial because they indicate areas where the market has found significant support or resistance. Price tends to react at these levels, either stalling, reversing, or breaking through with strength. Understanding these reactions can give you an edge in predicting price movements. You also have low volume nodes, which are areas where the price moved quickly, meaning not many trades happened there. These areas are often formed because the market did not spend much time at those prices, indicating that there was little interest from traders to transact there. Low volume nodes can sometimes signal opportunities for fast moves. When the price approaches a low volume area, it often does not encounter much resistance, leading to rapid price movement. This characteristic makes low volume nodes particularly interesting for traders looking to capture breakouts or quick momentum plays. When looking at the value area in combination with specific chart patterns, such as triangles or wedges, it becomes even more powerful. For example, if a symmetrical triangle forms within the value area, you can expect that a breakout from this pattern will have a higher probability of success if it is supported by volume movement out of a high volume node. Similarly, if a rising wedge forms near the upper boundary of the value area, it could signal a potential reversal, especially if the price starts to move toward a low volume node. Recognizing how these chart patterns interact with the value area can provide additional context for making strategic trading decisions. So, how do we use all this information to trade? The point of control and high volume nodes are great for spotting where the price is likely to stall or even reverse. These points often give you solid opportunities to enter or exit a trade. For example, if the price breaks above the value area, you want to look for increasing volume. This can signal a potential breakout that is strong enough to continue. On the other hand, if the price approaches a high volume area and then begins to reverse, it can mean that buyers or sellers are defending that level. This is often a great signal to trade in the opposite direction. There are a few trading strategies you can use with the fixed volume profile. One of these is the breakout strategy. A breakout occurs when the price moves decisively through a key level, such as a high volume area or the edge of the value area, accompanied by strong volume. If the price breaks through a high volume area, especially with strong volume, that is a sign the breakout might keep going. This is where you can enter in the direction of the breakout, but always confirm it with volume to ensure the move is real. Volume spikes are your key confirmation tool here, as they show commitment from traders supporting the breakout. Another strategy is the reversal at the point of control. The point of control, or POC, is a crucial price level where the highest volume has occurred within your chosen range. If the price moves toward the POC but fails to break through and reverses, it can indicate that buyers or sellers are defending that territory with strength. This gives you a great opportunity to trade in the opposite direction. Reversal trades can be highly effective when price action near the POC shows exhaustion, such as long wicks or repeated failed attempts to break through the level. You can also use a strategy called value area trading. The value area is where around 70% of the trading volume has occurred, and when the price stays within this area, it often moves sideways. This is what is known as range-bound trading. In this case, you can buy near the low of the value area and sell near the high. This type of trading works well when the market lacks a strong trend and is simply oscillating within a defined range. To add even more confidence to this strategy, look for clues like rejection candles or lower volume spikes near the boundaries of the value area, which can confirm that the price will likely stay contained within the range. Another powerful pattern to look for in combination with volume nodes is the failed breakout. A failed breakout occurs when the price attempts to move past a high volume area or a key support and resistance level but gets rejected. This is especially powerful when you notice that the volume does not support the breakout, indicating a lack of conviction. In this scenario, you can trade in the opposite direction of the failed move, expecting the price to return to its previous range. Failed breakouts are common around high volume nodes because these levels are where many traders have positioned their orders, creating strong resistance or support. Finally, consider the pullback strategy. After a successful breakout, the price will often pull back to retest the breakout level. If the pullback coincides with a high volume node or the point of control, it becomes an even stronger signal to enter in the direction of the original breakout. Pullbacks provide excellent risk to reward opportunities, as they allow you to set tighter stop losses just below or above the high volume node or breakout point, while targeting the continuation of the trend. Using the fixed volume profile is powerful, but you can make it even stronger by combining it with other tools. For example, pair it with a moving average to confirm the trend. If the price breaks above the point of control and you see that the moving average is pointing upward, this is a strong signal that you might want to buy. Moving averages can also help identify dynamic support and resistance levels, especially when combined with high volume nodes. The Relative Strength Index, or RSI, is another helpful tool. It can help you see when the market is overbought or oversold around key levels. If RSI indicates the market is overbought and the price is at a high volume level, you might want to watch for a reversal. Conversely, if RSI indicates oversold conditions near a key support volume level, this could signal a potential buying opportunity. Another important pattern to recognize is the double top and double bottom. A double top is a bearish reversal pattern that forms after the price fails to break through a resistance level twice, usually accompanied by decreasing volume. When this pattern aligns with a high volume node, it adds further confidence that a reversal may occur. On the other hand, a double bottom is a bullish reversal pattern that forms when the price hits a support level twice without breaking it, signaling a potential upward move. This is even stronger when it occurs around a high volume node, indicating significant buying interest. MACD is another great indicator. If you see a MACD cross along with a significant move at a key volume level, that could be a strong signal to enter. The convergence or divergence of MACD can also provide valuable insight into momentum shifts. For example, if MACD is showing divergence while the price is approaching a significant volume node, it can be a sign that the current trend is losing strength and a reversal may be imminent. Cup and handle patterns are also significant as they represent a bullish continuation, especially when formed near a high volume node. The handle's breakout point is usually accompanied by increased volume, signaling a strong continuation of the trend. Wedges, both rising and falling, are also key chart patterns to watch for when combined with the fixed volume profile. A rising wedge typically forms in an uptrend and indicates weakening momentum, often leading to a bearish reversal. This pattern is more reliable if formed around a high volume resistance area. Conversely, a falling wedge forms in a downtrend and suggests a potential bullish reversal, especially when it aligns with a high volume support node. Another useful chart pattern that works well with volume profiles is the cup and handle pattern. This pattern looks like a rounded bottom followed by a smaller consolidation, which resembles a handle. When this forms near a high volume node, the breakout above the handle is often a very powerful signal, especially if confirmed by strong volume. Cup and handle patterns, when aligned with volume analysis, can help traders identify strong bullish continuation opportunities. You might also consider Bollinger Bands as a complement to the fixed volume profile. Bollinger Bands can help you see volatility and how far the price may extend from its average value. If the price is nearing a high volume node while touching or exceeding the outer Bollinger Band, it may indicate an overextended move that is likely to reverse. Combining Bollinger Bands with volume analysis allows you to time your entries more precisely, especially when dealing with breakouts or reversals. Fibonacci retracement levels are another excellent tool to combine with volume analysis. When price retraces to a Fibonacci level that coincides with a high volume node, it becomes a stronger support or resistance level. For example, if price retraces to the 61.8% Fibonacci level and that level matches a high volume node, it can serve as a strong confluence zone for a reversal or a bounce. This provides additional confidence in executing a trade at those levels. Pivot points are also valuable for providing key levels in the market. When combined with high volume nodes from the fixed volume profile, pivot points can help you identify high probability reversal areas. If a pivot point aligns with a high volume node, it often strengthens that area as a key price level that traders are likely to react to. Using these different tools and chart patterns in combination with the fixed volume profile can significantly enhance your trading strategy. By adding tools like moving averages, RSI, MACD, Bollinger Bands, Fibonacci retracements, and pivot points, you will have a comprehensive understanding of the market. This layered approach will give you more confidence in your trades, as multiple confirmations often indicate a higher likelihood of success. Another useful chart pattern that works well with volume profiles is the cup and handle pattern. This pattern looks like a rounded bottom followed by a smaller consolidation, which resembles a handle. When this forms near a high volume node, the breakout above the handle is often a very powerful signal, especially if confirmed by strong volume. Cup and handle patterns, when aligned with volume analysis, can help traders identify strong bullish continuation opportunities. You might also consider Bollinger Bands as a complement to the fixed volume profile. Bollinger Bands can help you see volatility and how far the price may extend from its average value. If the price is nearing a high volume node while touching or exceeding the outer Bollinger Band, it may indicate an overextended move that is likely to reverse. Combining Bollinger Bands with volume analysis allows you to time your entries more precisely, especially when dealing with breakouts or reversals. Fibonacci retracement levels are another excellent tool to combine with volume analysis. When price retraces to a Fibonacci level that coincides with a high volume node, it becomes a stronger support or resistance level. For example, if price retraces to the 61.8% Fibonacci level and that level matches a high volume node, it can serve as a strong confluence zone for a reversal or a bounce. This provides additional confidence in executing a trade at those levels. Pivot points are also valuable for providing key levels in the market. When combined with high volume nodes from the fixed volume profile, pivot points can help you identify high probability reversal areas. If a pivot point aligns with a high volume node, it often strengthens that area as a key price level that traders are likely to react to. Using these different tools and chart patterns in combination with the fixed volume profile can significantly enhance your trading strategy. By adding tools like moving averages, RSI, MACD, Bollinger Bands, Fibonacci retracements, and pivot points, you will have a comprehensive understanding of the market. This layered approach will give you more confidence in your trades, as multiple confirmations often indicate a higher likelihood of success. Now, let us take a moment to talk about common mistakes. One mistake is ignoring volume when you reach key price levels. A breakout or a reversal without enough volume might be false, so always double-check the volume before making a move. Also, do not rely solely on low volume areas. Even though they can show where the price might move quickly, it is best to use other signals as well. Finally, remember to keep updating the range of your fixed volume profile as the market changes. If you only focus on an old range, you might miss new opportunities for support or resistance. The fixed volume profile is also a great tool for managing your risk. When you are setting stop-loss orders, try to place them just beyond a high volume node or the point of control. If the price moves through one of these levels with strong volume, it often means the market is changing direction. Also, think about your position size. You may want to take larger positions when the price is near high volume areas where support or resistance is clear. In low volume areas, it is better to take smaller positions since the price can move much faster and less predictably. You will also want to adjust your use of the fixed volume profile for different time frames. If you are trading intraday, use shorter time frames like 5 or 15-minute charts. This will help you see recent high volume areas and spot quick opportunities for breakouts or reversals. If you are a swing trader, try using hourly or daily charts to draw your volume profile. This will help you identify major support and resistance levels that could be important for longer-term trades. To summarize, the fixed volume profile helps you see where important trading volume happened at different price levels. You can use it to identify areas of support and resistance, spot breakouts, and look for possible reversals. Focus on the point of control, the value area, and those volume nodes to make better trading decisions. Also, remember to pair this tool with other indicators like moving averages, RSI, or MACD to add more strength to your strategy. Using the fixed volume profile well takes practice, and it is okay if it feels a bit tricky at first. Keep working with it, and eventually you will be able to spot those key levels faster and make trades with greater confidence. Take the time to experiment, make observations, and feel free to ask questions if you have them. Engaging with others who use these tools can also help you learn more and refine your skills.